Hi everyone, thanks for joining our channel. Once again, we're going to keep you updated with the latest news and information about real estate market. Don't forget to click on the like button, subscribe to our channel, and hit the notification button to keep updated with all the latest news and information that we put on this channel. Now, today we're going to talk about a very interesting topic, and that's the anti-flipping tax rules and regulations that have recently been approved, and now we have to be careful when we're buying a property to make sure that we're holding on to that property for at least a period of 1 year. Now keep in mind that in the past you were qualified to claim the capital gain tax, meaning that if you own the property, you only paid taxes on 50% of the increase. Now, if you buy a property and keep it for less than 1 year, then it no longer qualifies for that, and all of the profit that you're making is going to be considered income, and obviously you have to pay based on that. So let's assume you're making $500,000 profit. Now that $500,000 is part of your income, and it's going to put you in a category, tax category, that you're going to end up paying a lot of it to the government. Now, the entire amount that you are making is going to be taxable, and it's going to be considered as business income. Now, also keep in mind that the 1 year period is not written in stone, meaning that it's possible that if in special circumstances, the government will consider that as income, even if it's a little more than 1 year. Now, also, depending on your activities, if this is happening too often, the government might actually make an exception and treat you as someone that's generating income through flipping properties, and they might actually apply the same rule to you, even though if you kept it for a longer period than 1 year. Now, also, the other side of the equation is true, meaning that if special circumstances apply, meaning that maybe you're going through a divorce, maybe there's a death in the family, God forbid, then the government can make exception, and they might consider that as an exception to the rule, and you no longer need to pay the taxes that we just discussed. Now, another item that I wanted to talk about is in the past, a lot of people used to buy pre-construction projects, and they used to flip these pre-construction projects before the closing date, and they did not have to pay any taxes because the government did not know about these type of transactions. Recently, all the lawyers are supposed to report these type of transactions to the government. So even though you sell a pre-construction project privately, the government's still going to find out about it, and then they're going to come back and ask for the same type of tax, meaning that they're gonna apply the same rules and regulations, and they're gonna ask you to pay an income tax on all the profits that you made selling this property. Once again, there are exceptions that apply. If you purchase the property from a builder with the intention to move into it, and there was a life-changing event, let's assume your job got transferred from GTA to another city, now you have to move and you don't have any choice but to sell the property, then obviously the rule does not apply. Now, don't quote me for this, because at the end of the day, the government makes the decision. You have to still reach out to your accountant and lawyer and make sure that you're getting the proper advice, and you follow their guidelines and guidance, and make sure that you present your case to the government, and at the end of the day, they're the ones that are going to make the decision.